Inflation is back in focus after the Fed gave a bit of a hawkish forecast for its rate cut path in 2025. Bond yields jumping, stocks falling, while Powell gave his statement. We were here yesterday to watch it all. Here to give us a read on both the banking and the consumer and interest rates, Valley Bank Chairman and CEO Ira Robbins. Welcome. Good to see you in-house for a change.
Wonderful to see you.
Yeah,
Thank
it's
you.
great to have you here. Your reaction to what the Fed did yesterday, your reaction to a positive yield curve and what it means for your business.
Could not be happier to have a positive yield curve operating in a negative yield curve for a bank. And a bank like Valley, which generates so much of its revenue from net interest spread, has been a real challenge for the last 2 to 3 years. So even though we're sitting at 25, 30 basis points of positive yield curve today, that positive slope in itself is going to be a huge tailwind for banks, not just regional banks, but for all banks in general. So couldn't be happier.
It seemed as though the Fed chair was concerned, concerned, probably I made too strong a word, about inflation. Are you?
Absolutely. I think inflation is still running higher than what the Fed's target is. And there really hasn't been any kind of, we had an early reduction in what that looked like, but it's shown strength still. And I think the inflation is still going to continue as we continue to move forward. In conversations I've had with many of our borrowers, they're still seeing inflationary prices and the tariffs, I'm sure, which we all want to talk about at some point. I was with a borrower the other night and he talked about already implementing 10% price increases with the expectation of what may happen. Those conversations are beginning to happen, and there's this confidence perspective. When sentiment changes, then sentiment sometimes proves itself correct.
What industry was he in, if you don't mind my asking?
Apparel.
Apparel, because we were having this debate last hour over whether the apparel companies are really going to be hit by this, or did they absorb it last time? An interesting point that was previously made is that because we had tax cuts first last time, before we had tariffs, it kind of, helped companies cushion the blow. We're not going to get corporate tax cuts this time around, certainly not first. We might get the tariffs first, and I wonder if that dynamic will be different.
It's going to be 1,000% different. I think margins are something that have already been under pressure for a significant period of time. We've seen increased interest rates. The compression that we saw, so from an ability for a borrower to not have to pay as much interest may not be as much as they thought before. Now they're seeing price escalation. It's going to be challenging to how they're managing their overall bottom lines. They will definitely try to push it through, much more so to the borrower this time, to the end buyer, than what we saw last time.
Let's talk about deregulation. There has been, obviously, attended to the new administration, a lot of talk about deregulation that would affect the banking sector. What do you think about that as a broad question? And if there were 1 or 2 regulations that you could change or eliminate, what would they be?
And the banking sector and the broad U.S. in general has to decide, how inclusive do we want the banking sector to be?
Meaning?
At this point right now, we've made capital restrictions, regulation that is uninclusive as to where consumers cannot enter the banking industry and they're left going to somewhere else, whether it be a checking account because of overdraft protection, whether it be a shadow banking environment, payment rails are looking to move. We have put forth policies in place from a capital requirements perspective to how we think about bright lines within regulation that has made the banking industry be an uninclusive industry to so many people in the country. The negative impact.
The unbanked.
The unbanked. And it's increasing even when you think about traditional generational clients, entrepreneurs, where they're getting their capital from today. Credit is being delivered outside of the banking industry today. In general, shadow banking environment's great. But when you look at how does that align with the socioeconomic derivatives as to what this country wants, there's no fair lending that sits in these shadow banking environments. There's no CRA requirements that sit in these shadow banking environments. There's no disparate treatment that sits in these shadow banking environments. So we are creating a country where access to capital is being pushed out of the banking environment to organizations that don't have any of the socioeconomic themes that we've been talking about for the last 3 to 4 years.
And not just that, if something goes wrong, I mean,
So would you like to be more like them, or do you want them to be more regulated like you?
I think regulation is a good thing, to be clear. There has to be regulation in an industry like ours. We are an industry built on trust, but there has to be a regulation that just doesn't say I need to add 200 to 300 basis points of capital. What are we actually doing there? Are we making banks safer? Or that trade-off in making banks safer is harming another individual?
Is moving lending to another platform?
Moving lending to different platforms is something we should be doing. Banks innovate all the time, right? We think about technologies and transfers from a payment system, ATMs. Banks have innovated over and over again, year after year. So regulation that supports innovation is something we should definitely be focusing on. But regulation that takes hardworking consumers and takes them out of a banking industry is bad. We talk about commercial real estate today. Obviously, Valley has a significant exposure to commercial real estate. So what happens when we say banks can't lend into commercial real estate? Where does it then go to? It goes to organizations that, by the way, don't have affordable housing requirements associated with it. So where's the housing going to end up coming from? And who's it going to be for? It's not going to be for the intended outcomes that we're looking for. And in general, we need to really rethink through the entire regulatory approach within the country and what is the outcome that we're looking for. Because right now, the unintended consequences, in my mind, far outweigh the good that they're looking to see.